almost all of us at some point in life have felt the need to invest in the stock market, but we were clueless as to how do we go about. Some of us were hesitant to do it, thinking about the kind of risk that it brings with itself. And some of us started investing, but we did not know when and how to diversify. And there are a certain number of people who believe in the myths related to the stock markets. And the myths can be investing in stock markets is like gambling. It is impossible to beat the market. Stock market investing is too complex for the average investor. You can't invest unless you have a lot of money. Brokerage trading costs are too expensive and eat away profits. Or stock market investing takes too much of our time. But is this all true? Well, we shall explore this in our webinar today. The guest speaker for today's webinar is one of the most dynamic and leading technical stock market analysts in our country. We are truly humbled and honored to have him amongst us this evening. He is none other than Mr. Amit Jeswani. Mr. Amit Jeswani is a double charter, and in his cap full of feathers, he holds the degree of Chartered Financial Analyst from Virginia, USA, and a Chartered Market Technician from New York, USA. He graduated in business with finance from Kingston University, London, and he has been investing in capital markets for the last 14 years. He started at a very tender age of 16, as his father was a stockbroker, and he has had the opportunity to work with various financial giants. He's an active member with the Association of Technical Market Analysis and the Indian Association of Investment Professionals. He's the founder of Stallion Asset Private Limited, which is a SEBI registered independent equity research analyst company backed by the experts who have huge experience in wealth creation and in the Indian stock market. His firm is one of the few companies which has secured a portfolio management service license due to consistent value creation for the Stallion family. Without a further ado, I now request Mr. Jeswani to take over. So I guess you are on mute. I'd like you to unmute yourself, please.
Okay. Thank you, Rohit. Thank you so much for the kind introduction. Well, as you guys know, my name is Amit Jeswani, and I'm the founder of Stallion Asset. Stallion Asset is in two key areas. One's our research analyst platform, and one's a portfolio management services. These are the two businesses that we are into. A small disclaimer, there will be times I'll be taking names of stocks. These are not recommendations. These are just for educational purposes. Please do consult your advisor before taking any investment decisions. So this is a small thing about us, and then we go to something new that we've not learned before. A lot of you might have learned technical analysis. A lot of you might have learned fundamental analysis. But what we will speak about today is fundamentals. So it's a different kind of analysis that we are learning in the stock market for the last 5, 7, 8 years. So I'm Amit Jeswani. I'm the founder of Stallion Asset. This is where we started. This is not like the picture on the right. This is not my cabin. This was the entire office in 2014. From there, we have emerged to be an asset management company and one of the top 50 in the country. 7 years, all we did was create value for our clients, and we spend less than 1% of our revenues into marketing. So everything happens via word of mouth. We're the largest equity advisory company in the country. We're among the top 50 portfolio management companies in the country. So that's a very small introduction about us. That's what. So we secured a PMS license in 2018. In 2000, like end of 2018. In 2019, we were up 27% versus minus 4% for the benchmark. This year, the markets are down until 31st May 2020. We were down 9% against minus 22% for the index. Broadly, that's an alpha of somewhere around 40-45% in the last 1.5 years. So that's what we do. We invest public money. We invest for our clients money in the stock market for a living. So the macro outlook. Now, this is really important. Fed started in 1912. you can see the chart on the left-hand side of your screen. Fed started. So this is now the start of fundamentals. Fed started in 1912, and between 1912 to 2008, that is for 96 years combined, the Fed printed $900 billion. Between after the global financial crisis of 2008, Fed started increasing its asset size. What Fed does is Fed prints money and invests that money in bonds typically. Fed started printing money, and the balance sheet size from 2009 to 2019 went from $900 billion to $3.7 trillion. That was the total size of the balance sheet of the Fed. In the last 6 months, Fed has printed more money than that was printed in the last 108 years combined. So if you see on the left-hand side of the chart, this is an old chart. We are now at $7.2 trillion, by the way. So this is like a 15 to 1 month old chart, and Fed has printed $500 billion more. What Fed is doing, Fed buys a lot of stock, a lot of bonds, flushes the market with liquidity, and now interest rates are now near 0%. So more money has been printed in the last 6 months than that was printed in the last 108 years combined by the Fed. What that does is create bubbles, right? If you print so much money, there's too much liquidity, and liquidity causes bubbles. The Fed is very clear. The only way to come out of a pandemic or a crisis and a bubble is to create an even larger bubble. And that's what the Fed is doing. The Fed is buying right, left, center securities. So the last bubble, a lot of you will remember the PIGS crisis. PIGS was Portugal, Italy, Greece, and Spain. They were struggling in 2012, and the ECB, which is the European Central Bank, started buying bonds. If you see, the bonds of Greece were trading at 42% a yield in 2012. Now the yield somewhere around 2%. Same with Portugal, which was at 17% bond yields, and now it's at 0.8%. So massive money was made buying developed market bonds, which were in crisis, because the central banks would keep buying bonds due to money printing. The same thing happened, and bubble was created in NASDAQ. NASDAQ is now north of 10,000. NASDAQ is the technology index for US stock like Apple, Google, Facebook, all are listed there. So that's where the money went, and we saw. So what happened in the last 10 years will help us understand what will happen in the next 10 years. So I'm just telling you what happened in the last 10 years and how bubbles were created. If you see growth, if you see the chart on your left is MSCI Europe value versus growth. Clearly, value stocks underperformed, and what we are showing in the chart is that value underperformed growth, and the underperformance was very similar to the 10-year German bond yield. So more the bond yields came down, more the market started chasing growth stocks. On the right-hand side of this thing, we have shown data of last 80 years, where how every decade value stocks have outperformed growth stocks. But when you keep printing money, markets will start chasing companies because there is no growth in the world, right? We are in a world with 2% growth. When the growth is 0%, 1%, 2%, market loves companies that grow at 20, 30%. And that's where money has been made for the last 1 decade. The macro outlook. Now it's very clear for anyone who understands how economics works, it's very clear that there will be a bubble going forward. The question is, where will that bubble be? Now, first is gold. With massive money printing in the US, in Europe, and Japan, everyone's printing money. The only way to come out of a bubble is to create a larger bubble. And that's what everyone is doing. So can we have a very large trend? So it's very clear that we are going to have a bubble. Can we have that in gold? With massive USD printing, what we were taught in school and colleges, that the dollar will depreciate. But if other central banks are printing as well, then the dollar doesn't necessarily have to depreciate against the yen or the euro. Probably it will depreciate against the gold. And that's why you're seeing large position getting built up on gold. The second place, and which was the leader of the previous bull market, is Nasdaq. These are technology stocks. They have got better in this pandemic because we all use technology a lot more, and the importance of technology has never been higher than what it is today. Can that continue the rise what we've seen in the last decade? The third one is developed market bonds. You'll be surprised to know that that England came out with 2061 41-year due date bond, and that bond was for $7 trillion £7 trillion. That bond got subscribed in 60 seconds. This tells you at 0.5% interest rate. It just tells you the amount of liquidity chasing these kind of investments. Then you have the emerging markets. The emerging markets typically does well when your commodity prices are high. We've seen last on the 15th of April, 2 months before today, crude contract shut at the expiry happened at minus $37. Crude is now at plus $40 because there was so much crude that there was no storage place left in the world. So that's why crude contract settled at minus $37. This is for the first time in history. No one's seen negative commodity prices. Emerging markets typically do well when you have very high growth, and that's where money goes into emerging markets. The fifth asset, because you have bubbles, you also have an opportunity in cryptocurrencies. If everyone starts printing money, the supply of money becomes unlimited, and people ultimately will say that this is a rigged game, and probably there's a good chance that crypto comes into limelight. That's the 5 ways where we believe, where will the money go? The money has to go someplace, right? So these are the 5 places where the money can go. What has happened now? We are in the largest pandemic. IMF called that this is the largest recession after the Great Depression of 1929. IMF also pegged countries to grow to have a degrowth of 30-40% on GDP. But what has happened is, after the initial 40% fall, Nasdaq has already hit lifetime highs. S&P has recovered more than 70%, 80% of the fall. S&P fell from 3,400 in Feb to about 2,195, and now it's recovered back to 32, 36. It's the largest recession. Is everyone out there nuts to buy the stock market? Why is the stock market not falling? So we've gone from recession to depression to recovery all in less than 100 days. All this has happened because of one reason, and that one reason is money printing. US unemployment rate is gone to the highest level since 1929, and it is now near, it was expected to be 18%, but the numbers were better at 13%, and that's why the markets rallied more last week. Warren Buffett, as you might be knowing, he's been selling stocks, and he was pretty bearish on his on his May annual meeting. He was very bearish, and he was comparing the current crisis to 1929 crisis. But what has happened is completely the opposite. There isn't a single down stock in S&P over the last 10 weeks. Stanley Druckenmiller, a lot of you guys might be knowing who Stanley Druckenmiller is. Stanley Druckenmiller, for the ones who don't know, he's probably one of the largest traders in the world, and he is the right hand of George Soros. George Soros runs a hedge fund, and George Soros had made the Bank of England go bankrupt in 1992. Stanley Druckenmiller was short. Everyone was short the market. Once you know there's a recession coming, 33% GDP going down, there was no way the market could have rallied. But while in markets, the obvious never plays out, and that is what has happened. Stanley Druckenmiller, on his interview 3 days back, says that in a 40% melt up, he's up just 3%. Tells you it is very difficult to time the market. Now, this is what, again, coming to the last 90 days, if you see, I've given you a chart of last 15, 20 years. there's a very strong correlation between profit margins and S&P performance on the left-hand side. Well, that clearly isn't working now, and profit margins are gone to very low levels, near 2008 levels, but the markets are nowhere correcting. On the right-hand side, we've shown the correlation between S&P 500 and corporate taxes, the corporate profits after taxes. If you see, there's a breakup in the correlation, which was a very strong correlation. There's a breakup of that correlation. And this happened because if you make the interest rate 0%, now majority of bonds in Europe are negative. And if you make interest rate 0%, banks have no place to invest because the Fed is consistently buying bonds from you. Now, if you take away bonds, money has to go someplace. Money cannot stay in negative interest rate territory because you need to invest someplace, and that's what the Fed buying has done. So, is this a bubble, or is this here to stay? Well, the Fed will not stop printing money for the next 3, 4, 5 years. Powell, who's the Fed chairman, lately said that till 2022, interest rates are expected to be at 0%. Now, this is the Indian market. Coming back to local markets, till now I was just telling you that we've all learned fundamentals. We've learned technicals in college, school. We are in a world of fundamentals. No one in my school or my CFA taught me what interest rates can do. How can a central bank start buying junk bonds? In the US, Fed is buying junk bonds. Even companies who are bankrupt, the bond yields of those companies are like 8%, 9%. So it's a very interesting time where central bank himself is taking all the junk on its own book. Coming to India and how to build a pandemic-proof portfolio. Well, on 23rd March, we went for a lockdown. It was dangerous, and just think about it. When you're going in a lockdown, the panic is at the highest level. We had only 400-500 cases that time. Today we have 3 lakh cases. A lot of guys went out and sold as soon as the lockdown was announced. Well, what we have done since then is that the markets have rallied 35%, though the cases are up about 100 times. Market works on expectations. Even though we do not have a stimulus of anywhere close to what the developed world has done, markets will do things which you don't expect it to do typically. Now, this is the short term, and predicting the short term, as I told you, it's next to impossible. Principles at Stallion, the way we are looking at the next 1 decade. So a little about ourselves at Stallion. At Stallion, we look at what has created wealth and what has lost wealth. We typically do look at commonalities, what was common in the wealth creators and what was common in the wealth destroyers. And that's how we keep refining our investment philosophy. It helps us understand what works and what doesn't work. The most valuable things I've learned in my life is from the mistakes that we have done. Though we always promise ourselves that we'll never repeat those mistakes. India is a 30, 40, 50 stock market. Even though there are like 5,000, 6,000 securities listed, money is typically made in 30, 40 stocks, typically in every cycle. We'll get to that part a little later. Between 2008 and 2020, India went from a $1 trillion economy to $3 trillion. So India basically tripled in size. That means whatever we created between 1947 and 2008, we basically tripled in the last 10 years. So that's the amount of GDP where we went out. But if you look at corporate India, only 130 stocks delivered a 25% CAGR in the last 1 decade. That is what 5% of the market. If we go to the next last decade, the decade between 2010 and 2010, about only 19% of all stocks listed did more than a 25% CAGR. All fund managers, everyone tries to do 18, 20% or CAGR in the market. It's not so easy. Alphas are not very easy. If you look at last 1 decade, the Nifty's returns are 1.5%, 2% CAGR. Our earnings growth is 3.5%, 4% CAGR. That is what the last decade was. But we are very optimistic that there'll be more than 200, 300 entrepreneurs that will scale up and make it massive in the next 10 years. I'll just explain you what are our key principles for stock picking and what works for us. What we look out for is 4M. What we ideally want is a large opportunity size. The company has to be a market leader with that in that opportunity. The company needs to have a management who understands capital allocation and capital distribution and margin of safety. These are the four M's that we typically use for ourselves. Now, even while you're building a portfolio, you'll have 4 kinds of businesses that you should be or you can be invested in. Let's take an example of the first one, a good business in a good time. Let's take an example of gold finance companies. Gold finance companies are now at the best time ever because all other NBFCs and banks have stopped doing unsecured lending. And gold finance companies this happened in 2008 to 2010 as well, where unsecured lending stopped. Whenever unsecured lending stops, SMEs need capital and they go towards gold lending. Between 2008 and 2010, that was the GFC crisis, gold finance as an industry went up 3x. So these are now like companies like Muthoot Finance, not a recommendation, are in a good business in a good time. The second criteria is a good business in a bad time. India's total lending market is 100 lakh crores. Out of that, there are, and as you know, there is a moratorium going on. The good lenders are HDFC, ICICI Bank, Axis Bank. Those are the guys. So out of the 100 lakh crores, 70% is PSUs. PSUs have never made money in lending business in India. Odds are they will never make money going forward as well. You need great lenders who understand risk well. The private sector basket, the size of HDFC Bank in the 100 lakh crore market is 10 lakh crores. Axis is 5.5 lakh crores. ICICI is 6.5 lakh crores and Kotak is 2.5 lakh crores. That's the loan book size. These 4 lenders are 25 lakh crores of the total 100 lakh crore market. If India is going to double its GDP from 200 lakh crores today to 400 lakh crores in the next 10 years, I can guarantee you the lending size will go from 100 lakh crores to 300 lakh crores. You cannot grow without lending. It's virtually impossible. These 4 banks will not grow at 10% or 12%. They will grow at 20, 25%. The markets, because of the moratorium, have bid down these stocks 40, 50%. Of course, there will be credit losses, but these are good businesses going through bad times. The third one is a bad business going through a good time. This is where the largest money is lost. These are companies like infrastructure companies. So I'm just explaining you how we intend to invest for the next 10 years and what we've been doing for the last 10 years that has made us one of the best performing ones for the last many years. So I'll just rush this through a little bit. The second principle is market opportunity. And there are 4 kinds of businesses. A shark in an ocean. These are businesses which are large, but the opportunity size is massive. Companies like DMart. DMart is the lowest cost guy. I'll just give you an example here. Shark in an ocean. So globally, if you look at value retailing, or the one with the lowest cost wins all the time. The operating cost as a percentage of sales for DMart is 7%. For Reliance Retail, it's 26%. For Future Retail, it is 24%. It doesn't take a lot of time to understand who will win. The total number of Walmart stores in the US is 4,000. And the population of US is 32 crores. The total number of Tesco stores in UK is 3,100. The total number of DMart stores in India is 206, right? Big Bazaar is at 300 stores. Combined, these both players are 500 stores. So these are sharks in an ocean where the lowest cost guy will always win. Whatever cash it generates can consistently reinvest at high ROICs. The second one is a shark in a pond. These are businesses which are large, but the opportunity is small. Let's say Reliance in the refinery business. There's not going to be a large growth out there. But it is the only large refinery in India. So it becomes a cash machine so that's the second part of the kind of business that the third one are mid caps typically. The fish in an ocean. These are small businesses, but opportunity is large. You can make it, you cannot, like, depend on the management and all those kind of things. The fourth kind of business is a fish in a pond. So the business is also small, the opportunity is also small. These are the worst kind of businesses. You should never invest there. The size of opportunity is the foundation on which large wealth creation lies. Simply put, it's the size and duration of growth of the business that matters in the long term. The only sustainable way to make money and retain money in the Indian stock market is to bet in the sharks in the ocean. The first kind of the businesses which are leaders, massive opportunity size. So that's the first part. The second part we look out for is market leadership. There is nothing worse than competition in business. Monopoly is the only way to create a very, very successful business. Every business starts with solving a problem. Every business succeeds if it makes sure that it's the only one who can solve that problem. We do typically want to bet on companies who have a massive competitive advantage due to consumer advantage, a production advantage, a combination of both, or even a government advantage. Geo has a decent government advantage, I should say. Majority times, market leaders have the largest percentage of the profit pool. In most industries, 60 to 80% profit pools are with market leaders. If you see in automobiles, 70-80% of profit pool is with Maruti. In paint industry, it's Asian Paint. In undergarment industry, it's Jockey. In QSR, it's Jubilant Foodworks, which is Domino's Pizza. Apple sells only 13% of global cell phones, but it has 85-90% of global cell phone profit pool. The rest 87% are typically on Android, and they are competing on price. You typically want to bet on monopolies. Samsung didn't make money. Foxconn didn't make money. It's only Apple which made money. Entrepreneur's dilemma. This is something which is very important, especially for young entrepreneurs out there who are trying to to start their own business. Well, we invest in smaller companies as well. And most businessmen will tell you that, Amit, I'm in a 10,000 crore market. If I be 1% of that market, I'll do 100 crores. It doesn't work. It doesn't work. Don't be 1% of the market, because I can guarantee you will never make money being 1% of the market. You need to own the market. I tell them, find a 200 crore market and be 100 crores of that market. Build your monopolies and niches. Even Stallion, we also created a niche for ourselves in the advisory business, in the research analyst business. And we literally made it difficult for our competition to enter that business. So 1% share will not work. You need to create monopolies. Management. There are only two key things a management has to do. That is capital allocation and capital distribution. A management for shareholders. These are the two things that we look out for. The management himself about the business has to take three decisions to get to the capital allocation part. One is speed, the three S's. Speed, scale, sustainability. How large is the opportunity? How fast can I grow? How much can I scale, and how can I make it sustainable? These are the only three S's that matter in the long term while allocating capital. Reinvestment at what ROIC? Every business generates cash flows, and that that cash flow has to be either be invested back in the business or be given away as dividends. So there are only two kinds of companies we invest in: reinvestment modes and asset light compounders. The reinvestment modes are companies which can generate a lot of cash and can consistently reinvest for you at 30-35% ROICs. If you get that kind of companies, you will be a very, very, very rich man in the next 5, 10, 15 years. Basically, let me give an example of a land. If you have a land, a farmer is generating, it's a 100 rupee land. The farmer is generating 35 rupees on that land, and he keeps buying new land and can consistently reinvest for you at 35% ROICs. You're looking at a very large enterprise in the next 5, 10 years. We do not invest in bad promoters, but this is not the topic. Margin of safety. I'm sure in college, you've been taught a lot about how to value a firm, mostly via DCF. I can tell you with some conviction, and my data tells me the same thing. DCF or PE ratios or price to book only works if your company's growth rate is less than the cost of capital. In India, the cost of capital is 12%. Typically, you want to be in companies that grow at more than 12%, or else you'll never be able to achieve your goals of compounding capital at 15 odd percent. The way we value a firm is the amount of cash the company generates into ROIC at which it can deploy capital minus cost of capital into competitive advantage period. What this formula is trying to tell you is that how much are you going to generate cash and how much can you reinvest and for how long. This formula has been less taught in school, but it's probably the most important formula that works in this stock market. Market cap to opportunity size. Let's take an example of Godrej Properties. Godrej Properties, there were 700-800 builders in every city till 5 years back. Today, there are about 4 or 5 builders in every city. So once you get the Godrej's, the total real estate housing market last year was 4 lakh crores. Godrej did 500,000 crores of sales. 76% of Godrej property sales happens in the first week of launch itself. Godrej doesn't construct its own building. It's been outsourced to Capacite. So if you think about, Godrej doesn't even buy land. The land owners do a JV with Godrej that you do everything and we will give you 70% of the profit, something like that. Godrej Light has made this asset heavy industry or asset light industry. The land is not mine. The construction that I'm doing is not being done by me. I can sell the flat on day one because I'm Godrej. Think about the value creation that happens. So you need to bet on these great businesses where you will not see free cash flows here, but you bet on opportunity size. A 4 lakh crore industry, 16,000 crore market cap. How much can this guy scale in the next 5, 10, 15 years? Madness of the crowd. So something, it would be too technical, but typically price follows fundamentals. But in financials, fundamentals follow price. If you can dilute, NBFCs and banks need capital and they need to keep diluting. And if you can dilute your capital at high price to books, it's basically raising cheap source of capital. So rising prices in financials will lead to better earnings. It's the other way around. Falling prices in banks and NBFCs will make the business even worse. Deep value investing. So this is my strong belief. Deep value investing works only in textbooks, Twitter, and Facebook. Deep value investing doesn't work in real markets. So a lot of people will tell you Benjamin Graham and all that doesn't work. We invest largely in 4 sectors: consumer, financials, pharma, and technology. I'm just going to the last slide, just rush this through so that we can answer some questions. Our portfolio is a combination of 4 sectors: consumer, financials, technology, and pharma. Now think about it. Consumer and pharma are defensive, whereas technology and financials are high on beta. Broadly, the high growth sectors in India is technology and financials. That's where our growth comes, and that's where we make a lot of money in a bull market. Whereas our consumer and pharma portion help us in a bear market. So if you see this bear market as well, financials are down 40%. Consumer is positive because money is moved to defensive. Pharma is positive this year. So that's how our portfolio is structured. A big ass opportunity, predictable earnings growth, smart promoters, happy customers, asset light kind of business, low, like great capital allocation is what we typically look out for. Our portfolio has 15 odd stocks with some weight in trends and some weight in a quality basket. Given a choice of high risk, high return and low risk, decent return, we at Stallion always choose low risk, decent returns. You have to be there in the game 5 years, 7 years later as well. A change is constant. These are my principles, but my principles keep changing. I thought I was a smart person in 2017, but by end of 2018, I realized that 2017 तो बहुत पागल था. अब मैं बहुत होशियार हो गया. And the same thing happened in 2019, where I thought that I was smart. But every year you keep learning. These are our principles, and principles will keep changing going forward. So thank you everyone for being patient and listening to me. Any questions, Rohitji? We can take it forward. Hello? Hello?
I think there was some technical glitch. I'm so sorry about that.
No worries, no worries.
Please go ahead.
No, I'm done. Rohit is done.
All right. Okay. So we have one question from Professor Shilpi Agarwal. She wants to know, do you think that the Indian market has made its bottom, and what kind of recovery do we expect from here on?
So if we see Nifty's EPS last year for FY20 was 470 for this thing. Now, if you take the best case FY22 estimate, I'm taking FY21 out. If we take the best FY22 estimates, it is somewhere around 490 on the EPS, Nifty EPS. The worst case is at 430. Broadly, we should bottom out at 20p here and there, but it's not that the entire, like, there are sector trends that will do well. So not everything will do well, but there are select monopolies. So let me take an example of something like SBI Cards or Bajaj Finance. These companies will come back with great speed. They are down 30, 40, 50%. Something like consumer baskets are already hitting new highs. So Nifty, 12% weight is Reliance. Reliance should do well. It's part of our portfolio, just a disclosure. The Nifty, I believe, has bottomed out. Fed will not stop printing money. Nifty should do decently well, but you will not make money on the overall market. You will make money in select pockets. And India has always been a narrow market. India is a 30-35 stock market. Between 2009 and 2014, the Indian markets went nowhere. But consumer and pharma companies were growing at 30-40%, the likes of Page Industries, Lupin, Sun Pharma, and those stocks went up 20, 30, 40 times where the index went nowhere. We need to find pockets of growth. Wherever there is growth, the markets will chase it. So I believe technology, so my portfolio, the way it's structured today, since we only be in 4 sectors, technology is at 32%, consumer is about 35%, pharma 20%, and 20% financial. So that's broadly how our portfolio is structured. For the last 7-8 years, we were 50% financials, and financials made massive money for everyone. So it was financials when the economy was good. Now we've cut down some banks and financials out of the portfolio. So yeah, don't worry too much about Nifty. Look about stocks where promoters are increasing their ROICs, growth. I'm telling you, bull market, bear market, there is always a bull market in 30, 40 stocks in India.
Thank you so much for that, sir. So there's one question asked by one of the participants, Mr. Rakshit Ramesh. He wants to know about the future of crypto in India. And how can small-time investors become a part of cryptos?
We're regulated by SEBI, so we try to not speak about cryptos at all. Rohit, I won't be able to speak a lot about cryptos. So it's a
All
very
right.
messy thing to speak about cryptos.
Okay.
But
Okay, I
you
understand,
should
sir.
look at it. You
All
should
right.
look at it. I would
All right. Maybe that's an answer for him. Anyways,
say.
so there's one question asked, and this question is how and to what extent do you think that the ban and boycott of Chinese goods is helpful for India in the practical manner, and how will it affect the stock market?
See, actually, there is no real, like, it's very difficult because these are very macro kind of things. Think about it. All your ACs, the compressor is made in China. Not one company in India has been able to make compressors. I know Dixon, Amber are trying to do that, but no one has been successful. These are just assembly lines. It's very difficult. Like API. API is a $55 billion market. But out of the 55 billion, only 5 billion of total APIs are produced in India, and you need the entire supply chain of intermediates to make APIs, and that's not going to come in India. India is doing. You need that kind of investments. You need entrepreneurs getting credit. We get capital at 12-13%. It is virtually impossible to get capital at 12-13% and do business in India. So am I bullish on Make in India? Yes, I'm bullish, but I'm bullish on MNCs who are listed in India. Let's take an example of Honeywell Automation. Honeywell Automation's turnover is $20 billion. Out of $20 billion, the COGS is the cost of goods is about $8.5-9 billion. Out of $9 billion, about 200 million is made in India, right? And about $7 billion is made in China. So out of that 7 billion, some can shift to India. But large shifting of India, I don't see, because consumers will never choose. It's very difficult market. It looks good theoretically, but very difficult. I need to see some. See, think about it. We were in the largest pollution crisis in China, right? Chemicals were banned. Look at how much capex was made by chemical companies. There was a $35 billion displacement because of pollution crisis in China from 2016 to 2019. You will not believe the total capex that all chemical companies did combined in India was $1 billion, right? And this is the best times ever for them. And they did $1 billion out of the $33 billion. So Indian entrepreneurs need to scale up, and that's you need to bet on people who are scaling up. So I don't see that for now.
Right. Thank you so much on that. So one of the participants would like to know what happened to Karvi Stock Exchange, and will the investors get back their money stuck in Karvi stockbroking?
Even Bajaj Finance had written that off from his books. So if you see Rajiv Jain, who they had also lended money to Karvi, we don't track what's happening to the brokerage side. It's very unfortunate that happened in last 20 years. If there is one thing which puts because it's the stock market is only place in the world, I think, which is 100% cashless. It is extremely heavily regulated because we know how much regulations are. It is very, very difficult to cheat the regulators, the custodians, and everyone. Karvi did it. It's very unfortunate that people lost money, but I don't think it is that easy and it will happen again. So will investors get their money back? I hope they do. But if you see the history of Indian scams and getting money back is not so good. If you remember, Jignesh Shah's company had also done a commodity scam of 13,000 crores. None of people got that commodity exchange money back.
All right, so and one more question. Now, how do you think businesses will now manage their DSR, having worked on high leverage in the past? DSCR.
You mean the receivables?
Yeah.
See, good businesses do not give only receivables. So for us, if you take more than 60, 70 days to get their money back, it's a bad business because you will never be able to scale up. Your business has to be asset light. So small businesses are going to struggle because money is not coming back in the system. We stock market investors are very lucky because out of 6,000 businesses, we need to choose 15 businesses that we like and understand. The economy will go through challenges, massive challenges, and that's what creates larger monopolies because the larger players get larger with time. The smaller players will get out of every industry, be it restaurants, be it textiles. I don't think you can do business if you don't have a massive competitive advantage over the larger players. Look at industries. You have to create a monopoly if you are into business. You have to solve large customer problems. You have to give the way of thinking that highest quality, higher price, lowest quality, lower price is over. Now we are at the thing of lowest price and highest quality. And the one who can get that done, that two things done. Geo gave you highest quality at the lowest price, right? It's companies that those are the companies that will create monopolies. Small businessmen be on technology, be ahead on technology, or the game's going to be over. So that's why we have a company called India Mart in our portfolio. So India Mart has 1.5 lakh SMEs on the portfolio. I'm telling you that it gets more website views than Quicker, Zomato combined. So you should look at companies like India Mart. They're listed on the stock exchange. This is not a recommendation. We have vested interest, but those are the businesses that will scale. You've seen what's happened to Shopify. This is a $1 billion business. They have an 80% customer renewal rate, and basically customers, it's a subscription business. It's a cash machine. 80% of their entire balance sheet is cash. They generate 700 crores of revenues, 300 crores of free cash flows every year. You want to be in technology businesses. You want to be in businesses that are going to create monopolies. That is where the only possible way to create monopolies. And do not miss out these businesses with large network effects. Network effects is more powerful than any other moat. So we have consumer moat, we have production moat, but the most powerful moat is networking moat. And companies like Naukri.com or India Mart, which are listed in India, we might have vested interest. Please do your due diligence. Will become, they are $1 billion, $2 billion companies. They are going to be massively large in the next 5-10 years. So technology monopoly should be your number one interest right now.
All right, thank you so much. And so would you quickly just like to comment on the real estate sector? Do you think it's going to take comparatively a longer time for these guys to revive, or how is it? How do you look at it?
I believe Ram Mohan, Sham Builder, Mohan Builder, all those builders are going to die. I was of the view that 70% builders will die. Now I believe 90% builders will die. So if you look at Khushru Junjuna, who's the CEO of Pyramid Finance, they're the largest lenders of real estate. They know more about the industry than, of course, everyone. They've lent 70,000 crores to the industry. When you speak to them, it's very clear that the ones who survive will become very large, right? The total number of organized real estate players in India is by size are just 8%, right? I'm speaking about the top 5 cities. Out of these 8% pie, and this pie was the same in China as well. In China in 2004, it was somewhere around 6-7%. Today, if you look at China, 80% real estate is organized real estate, right? All these real estate builders went bankrupt in 2011 because you might remember there were ghost cities that were made in China. All builders went bankrupt, but the good builders became large. See, if you understand the real estate business, it's a great business model because you get 4 years ka advance. If you can sell a flat today, pre-book a flat today, you don't have to. If you can sell by photos, right? It's a 400-500% ROE business model. So only few companies will be able to do that. Commercial real estate, we are a little negative right now, but residential will do well. So my pick is residential real estate stocks, and residential real estate in Bombay for sure has bottomed out. This is the bottom for residential real estate. Commercial real estate should do medium, like probably not even give you large returns anymore. And rental or retail, that's the worst. So we would strongly avoid retail. But residential real estate for like stock prices as well as real estate prices have definitely bottomed out because there is no profit margin. The profit margin now is 5% for all real estate builders. So how less will they go from 5%? Even the most efficient real estate builders. So there is no way the supply has gone down 80, 90%. So there's no way new supply is not coming. So after 2017, new supply is down 80%, 90%. So no new projects are getting launched. Once this inventory gets over in the next 1 year, 1.5 years, real estate should move north, not south. In Bombay, I know. Hyderabad is another thing because there's been a explosion of real estate builders, and it's a very different market. Hyderabad is booming and doing really, really well in real estate.
I mean, it's just amazing to know about all of this. A small question, but a lot of information, which is very, very valuable. One participant has asked a question. Immediately once the lockdown was relaxed, we saw a lot of demand in liquor sector. Do you think it is safe to invest in the liquor sector right now, or is it momentary?
There are only two good liquor companies, USL and United Spirits, which is owned by Diageo. They're the largest whiskey makers in the world, and UBL, which is United Breweries, which owns Kingfisher, and that's owned by Heineken. Just invest these companies for next 5, 10, 15, 20, 50 years, and you will keep compounding your capital very well. So when Diageo came in India, they got screwed over by Mr. Malia. The balance sheet was not so good. But if you see now what they have done, they've done really well. So don't buy for next 1 month. Buy these kind of companies for next 20. Your kids will also make money because they will also drink alcohol. So, and there will be no new competition coming. Think about it. You have seen when you were 20 years younger, 10 years younger, 5 years younger, you have seen the exact same brands. There is no new competition that emerges. So if you don't have competition that emerges, you can keep compounding your capital at these companies will become extremely large. If you look at China's largest company, not non-technology company, it's an alcohol company. The market cap of that company, Lungchu, I can't pronounce it, sorry, but it's $150 billion. The market cap of USL, which is United Spirits, which is Diageo owned, is $7 billion. For USL, for UBL, it's $5.5 billion. So if you can get 50% of whiskey share and 50% of Kingfisher share, whoever drinks wherever, you'll keep getting rich. So you don't have to think about them, what will happen next quarter, next week, next month. Look at them for the next 5, 10 years. We might have vested interest in USL.
All right, thank you so much. So that marks our last question. But so I have a question for you. So being a very amateur investor, what is your advice to people who have just started investing, or what's your advice to the young generation as to what is it that they should look at while investing?
So if you want to do mutual fund investing, you will get 10% odd CAGR. That is what I expect. Which is decent because it's 4-5% higher than the market. Do not do intraday. I've been a trader myself, but I keep telling people, do not take leverage. Do not do intraday. There are no faster ways to die in the market. In this game, I'll tell you one thing. You cannot work for 8 hours and be rich. It doesn't work that way. Here, this field attracts the smartest guys from the smartest schools, colleges, and these are the smartest people. They will eat you in no time. You either work 16 hours daily, 14, 15. If you're not ready to commit 12, 13 hours of your time in the stock market, you will get killed over, because in this, out of the 100%, only 5% make money. 95% lose money. But the good part is the 5% take everyone's money away. It's a zero-sum game, right? You have to be in the 5% again and again, and that will come only by hard work. If I stop working hard 1 year from today, I will come in the 95% part of the game. So it is continuous hard work, but you will win for sure. So read a lot of books, invest small, and as you start winning, you will lose money for sure at start. But the best tuition fees you will pay in the stock market is by losing money. There is no other way to learn the stock market but by losing money. I guarantee you will lose money at start, but don't get discouraged. I went bankrupt 5 times, so you don't have to worry. And I'm a portfolio manager today. So that's how you learn. So try to lose money. Be focused on that 14, 15, 16 hours game. It's not going to be an 8 hour a week. If you think 8 hour a week is for you, do not even try to get in this game. This is a very different game. So yeah, that's my advice for everyone. And mutual funds are good for 10% CAGR.
Right, right. That was absolutely food for thought. Any suggestions for books that you would advise the people to read up?
So on basics, I can tell you how. So read everything what Warren Buffett has said till now. Read his annual newsletters. You will probably take 1.5 months getting that down. It's 4 or 5 pages this guy writes. This guy is done very well. So I learned my portfolio allocations from Warren Buffett. I learned my risk management by this trader called Jesse Livermore, and he's written a book, Reminiscences of a Stock Operator. It's written in 1920. This guy is the best trader in the world. There is no trader who's better than this guy. I learned stock selection from Peter Lynch. So that was One Up on Wall Street. So these are basic books that I'm giving you. So if you can combine your portfolio of Warren Buffett, like portfolio allocation like Warren Buffett, stock selection like Peter Lynch, and risk management like Jesse Livermore, I believe you will be unbeatable in this game. So I've learned from a lot of people, but these three are primary and these are basics, and you love reading them. Do not miss Jesse Livermore, Peter Lynch, Warren Buffett. Like, it will make you a different person altogether. And these are very small 200-page books, so you'll love reading them.
Absolutely, sir. Thank you so much. Before I hand the session over to Professor Baisakhi, I'd like to thank you from the bottom of my heart for accepting this invitation and being here on the panel. And I can tell you, every single participant has sent out messages saying that this was a fantastic session, and I couldn't agree more with them. So thank you so much once again for joining us, sir. It really means a lot, and we look forward to our continuous association in the future.
Thank you, Rohit. Thank you so much. Amazing being here. Thank you.
Right. Now I request Professor Baisakhi to give her closing comments.
Good evening, Mr. Jeswani. It was amazing. It was simply mind blowing. I learned a lot of things from this session. So we come to the end of this session. We need to thank our director, firstly, Dr. Dinesh Nilkan, for his continuous support and advices he has done to take this webinar series going. I would like to render my thanks to Professor Sunita BK, Dr. Umakant S, and Dr. Raghu Anand, our HODs, who have been instrumental for this webinar series. I also like to acknowledge our HODs, Rupa Teresa, Dr. Bhargavi Hemige, Anila Bajpayee, for their continuous support and acknowledgement. And I would like to thank our coordinators, Ms. Jayashree, Ms. Chaitra, facilities manager, the teaching and the non-teaching staffs for this webinar series to go on. Once more, thank you so much, Mr. Jeswani, for giving this very, very insightful session where we learned a lot of things. And you can just have a look at the chat box that how people have been kind of benefited from your talk. And last but not the least, I would like to thank all our dear participants for making this webinar a very successful one. Thank you so very much.
Thank you. Thank you. Thank you, everyone. Thank you so much for joining us. Thank you. Thank you, madam. Bye-bye.
Thank you, sir. Look forward to seeing you in the future.
Thank you.
Thank you. Thank you. Bye-bye.
Thank you, sir. Good day.
Rohit?
So participants who've joined us from across the world, from different cities of India and from different parts of Bengaluru and the state of Karnataka, thank you so much for joining in. It is a pleasure having you all with us here, and we look forward to seeing you all in our future webinars. I hope you all have filled in the feedback form. If you've done that, you should be receiving a certificate within a week's time from now. And once again, a hearty thanks to all of you for joining in. Have a blessed evening ahead. And